I'm going to tell you what a conventional loan is. A conventional loan is a loan that helps you get a house. You can use the money you get from a bank. That is a loan. When you take that money from the bank, that's borrowing. You have to get money back in time. And when you do that, you get a loan off, and then you have your own house. Hey, Dad, am I correct?
Wow, that was actually pretty cool. I think he's getting on somewhere. And today, great job, by the way, we're going to talk about conventional loans. Good evening, everyone. Let's talk about a conventional mortgage, a popular home loan option offered by private lenders by banks and also the credit unions. Unlike some loans, it's not backed by a government agency, and it follows guidelines set by Fannie Mae and Freddie Mac. So what do you need to qualify? First, a credit score of at least 620, though higher scores can unlock better rates. Next, you need a down payment, typically between 3 and 20% of the home's price. If it's less than 20%, you'll likely need private mortgage insurance, or PMI. If you're interested in knowing what that's about, you can also check one of my previous videos I've created as well on that topic. No matter the case, you also need a debt-to-income ratio that should be around 43% or lower, though some lenders allow up to 50%. You also need stable, verifiable income with at least 2 years of employment history. The loan must stay within conforming loan limits, which currently is at $806,500 for a single-family home, and that's in most areas in 2025. Though there are some other high-cost region areas, like in California, where it's as high as $1,209,750. That's also in 2025 right now for the current standard. Let's take a moment to look at the general layout of a conventional mortgage through observing an example here. Okay, so now we're going to take a look at a conventional loan. Now, with this particular conventional loan, it's going to be a 30-year fixed rate loan, okay? And we're going to have a 5% down payment. Now, if we're having a 5% down payment, that means that we are going to need to get PMI, private mortgage insurance. So, we're going to need to have that. Now, the value of the property, this is our property here. The value is at $650,000, and the person has a 740 credit score. Now, with the 740 credit score, that's going to allow them to be able to get somewhere around a 6.25%. Somewhere around that area is what they should be able to get, generally speaking, currently, right now, with our current interest rates that we have. This could change, obviously, in the future. No matter the case, though, the value of the property is $650,000. So at $650,000, what we would need to do next is we have to go ahead and figure out what the down payment would be for that. And to do that, we're simply going to take the $650,000, multiply it by 5%, and that will give us our down payment, which would be $32,500. So in other words, we take $650,000, we multiply that by 0.05, and that gives us our $32,500. Okay. Now we can take that amount there and subtract that from 650,000. Remove the negative, of course, and that would give us our mortgage value, which would be $617,500. Exactly what we have over here. Okay. So that's how we end up getting to that. Now, to be able to get that, the PMI, the private mortgage insurance, pretty much, we have to understand first off that that's going to be 15% of what remains. Because typically, in most cases, you're supposed to put down 20%. We're only putting down 5%. So therefore, that's going to place us into a scenario where we have to be able to cover PMI with the other 15%. Or use PMI, I mean to say, to cover the other 15%. So in doing that, in most cases, on the low end, with the PMI monthly payments, they're usually going to be about pretty much 0.8% to as high on the high end of 1.2%. So I'm going to average out about 1% is what we're usually going to be right now in this particular scenario. Keep in mind, that the PMI also encompasses their LTV, so their loan to value ratio, as well as their credit score too. So that can have an impact on that percentage of them going either from a 0.8 all the way to as high as a 1.2. We're going to average that out, generally speaking, with a 740 credit score, and with this LTV, they're probably looking at like a 95% LTV, because obviously they're only paying 5% down, so they're not, out of 100% of the loan, they're only paying 5% of it, so their LTV is going to be, the loan to value is going to be 95%. So based on that alone, I would say they're probably within the area of a 1% for a PMI. Now, anyways, with this PMI here, in order to find it out, what you would end up doing is you pretty much would take the mortgage value of the $617,500, and you pretty much multiply it by 1%. And in doing that, you're naturally going to end up with $6,175 is what that would be. That's 1% of that. And then you're going to take that 1% there and you're going to divide that by 12 for 12 months throughout the year. And that's going to give you the 514.58. So that's how you're going to get that PMI in most cases there. Now, with the 6.25%, in order to get the monthly principal and interest, I'm going to do a lot deeper math in order to go ahead and end up with this. So I'm not going to go into details on that, because that is very deep broker math that I'm not going to get into, honestly, at this point. This is our conversation we're going through today doesn't really specify into these specific details, so I don't want to go that far in on you guys. No matter the case, so just know that with this example, it's going to come out to around $3,804.30 for their principal and interest on their monthly payment. Now, when you include also the PMI with that, then all within there, that's going to equal about the $4,318.88 we see here. Now, I want to also note here that this does not include any HOA fees or homeowners insurance fees. So if you have, most typical cases, most don't usually have HOA fees, but they can occur. At least up here in the Northeast in most cases. We don't have that much. In Florida area, you may experience that at times where you have HOA and even CDD fees and things like that too. But anyways, homeowners insurance is a typical one that you usually see, and typically around this area, probably looking at maybe an extra $150 or something like that a month to $200 a month in that area probably. So you're probably looking somewhere around $4,500 is what you're probably going to be looking at paying a month for your mortgage and such, which includes your principal, interest, your PMI, your homeowners insurance probably, and if the HOA fees there, they're raised a little bit higher, of course, too. No matter the case, so this is generally speaking kind of how you would end up getting to this type of monthly payment with a conventional loan. And this is generally speaking how a conventional loan is set up. Now, keep in mind, like I said previously, in most cases, you really want to do a 20% down payment, but those do a 5% down payment. I remember when I purchased my first home, my wife and I, we ended up doing a 5% down payment. And that's all we had at the time, and it worked out. We ended up getting PMI, and we ended up paying our PMI until eventually it was paid down, where we ended up losing it. Because remember, with PMI, when you get to a certain point, when you reach 80% of the loan value, of the overall mortgage value, you end up being able to request to have the PMI removed. And if it gets to 78%, it must be removed by the lender. So those are things to always remember and keep in mind too. This was explained very well back on my PMI episode, if you want to check that out. No matter the case though, this was a good example here for a conventional loan. And if you guys have any questions off of this type of a loan, feel free to go ahead and add those questions in the comments down below too. I'd be happy to go ahead and clarify, as well as maybe even helping you with your own scenarios that you may have. Happy to help. So I hope this example proves to be very helpful to you, and if you have any questions, please feel free to ask them below. Finally, be ready to provide documentation. That's W-2s, pay stubs, tax returns, proof of assets, and ID. The home itself, it must meet the lender's and the appraiser's standards for condition and value. Every lender's criteria can vary slightly, so always check with yours for specifics. Lastly, if you like my content that helps you stay informed, then please take a moment to like and subscribe, and share it with others, and happy home buying.
Like subscribe.